Hello and welcome to Business Incorporated live on Channels Television. It's another trading week and Iran jitters already pushing major markets at this time. Here are the top stories right now. Africa's startup ecosystem is showing signs of renewed momentum. In February alone, raising $272 million in funding. And South African rand has weakened to its lowest level in 3 months, highlighting renewed pressure on emerging market currencies. And all markets have kicked off the trading week on a strong note, with crude prices climbing above $100 per barrel. And it's great to have you join us. I'm Ladi Williams. And yes, we see for the commodities that we track, oil again surging to start off this week, touching $119 a barrel earlier. It's a highly volatile session there. And now we're trading $105. Last time we took these numbers, $105.86 a barrel, with a 13.30% uptick there, following the volatility starting off this trading week. WTI over $100. Who would have seen this coming? Yeah, in March, WTI is over $100, and we know this is the grade the Dangote refinery likes to buy. 13.39% up right now. A few minutes ago, natural gas not left out of the party, but a laggard when you look at Brent crude and WTI, what they're doing there. $3.37, up 5.78%. So much to unpack right there in the oil market. Let's try and get Chinan Dickwell now. He's the Vice Chair, Africa Energy Council, joining me via Zoom. Hello, Chinan.
We are already warning.
All right.
And
I guess we have Chinan there. All right, Chinan, as expected, just like last week, oil prices continue wild swings this week. How are you seeing what's playing out so far? Definitely touching over $119 per barrel. I believe you're in Qatar right now. Talk to me about your experience so far over there.
Yeah, so I'm actually in Saudi at the moment, but you're 100% right. It's been quite I'd say, a very humbling situation the last the last week, actually. Missiles raining out from the sky and all of that. But thankfully, things are much calmer and under control. But just going back to the oil markets, Nadi, I think there are a few things to bear in mind. The first is when this whole thing started, it was quite apparent that there was a bit of restraint from both sides. You could see that it was more military. They were going for military targets. There's a base, a US base, not far from where I live, and you could see that it was strictly just, the military targets. But this has since escalated. And what you would have seen in the oil price markets is people were pricing geopolitical risk. We went from about $69 per barrel all the way to about 80. That $10, $11 was mainly geopolitical risks. What you're seeing today in the markets, Nadi, we've moved away from pricing geopolitical risk to actually pricing lost barrels. In the last few days, there have been huge attacks on energy infrastructure. Energy infrastructure, refineries and pipelines, lots of them being damaged. And that will take weeks at the most optimistic, if not months to fix. And you can see that the market is responding to that. So you mentioned it. $119 per barrel is a number we haven't seen since 2022. So this is new territory with all due respect. And I think, and unfortunately, this might continue for a while from all what we're seeing.
We're getting forecasts of maybe $150 per barrel. And, looking at the performance last week, we see Brent did close out the week 27% higher, WTI 35.63% higher. That's for the week, because it's 6th of March last week. And definitely we're seeing this week also kicking off volatile. Looking at WTI, that's the one the Dangote refinery, I believe, likes to buy. So talk to me, what does this mean, for energy prices? We're already seeing at the pumps, prices are already going up, gradually. Talk to me about what this means.
That's a great question, Nadi. So I'll say this. At the African Energy Council, we've been crunching some of these numbers. So at $60 per barrel WTI, if you look at the Nigerian cost stack, so what I mean by that is if you take a liter of PMS, a liter of petrol, Nigeria, normally the cost of the crude oil is about 50%, 49, 50%. Just the cost of buying the feedstock, the crude feedstock. So on top of that the crude feedstock, you put the cost of refining, you put refining margins, you put port charges, you put taxes from the Nigerian state and all the levies, and all that would stack up to give you a number, let's say 774, which is what the gantry price was before. Okay, that's what it would give you before. But I think the key thing here is feedstock price was approximately 49 to 50%. As we are speaking right now, the feedstock price has gone significantly higher. We're talking just north of 60%. So the feedstock price, just the price to buy WTI, and refine it accordingly, has gone up over 60% of total stack cost. And you can even hear the NNPC speaking about this. I think we just had the NNPC making comments to the effect that they are aggressively going onto the market to get products, WTI from the US, to make sure that Dangote refinery keeps going so there's no shortfall and disruption. But this is the new reality that we're finding today. And I'll just say this, Laddie. Many people do not realize how seismic this conflict is right now. And there are three reasons why this conflict is really off the chain at the moment. I'll say this. The first, of course, is the choke point at the Strait of Hormuz. I know you've discussed this quite a lot. The backlog, about 20% of just crude oil, okay, supply in the world is being to the markets, number one. But number from Qatar that is also not being able to get to market. That's the second one. Now, the other thing to think about is also the shipping disruptions, is also the insurance costs, is also the refining logistics. There's several dimensions in this conflict, just that region alone, that disrupts a lot on the global scale. Even agriculture. Qatar supplies approximately, I think, 10% of global fertilizer, urea-based fertilizer in the world. All of that's down right now. So even agriculture in Africa would be impacted. There are so many dimensions when you look at this conflict, and it's very, very sad.
All right, so definitely we know all producers somehow, should be insulated. They should be able to supply their refineries with feedstock. Looking at countries like South Africa, we've seen the negative impacts with oil prices, rising so high because they are a net importer, of energy. So where does Nigeria stand in this? Are we a net producer or a net importer at this point?
Great question. For Nigeria, I always say there are two sides of the coin. One side of the coin is the Nigerian state government. It's great news for us. $110 per barrel of crude oil is great news because, we get a lot of revenue. We're producers, oil producers. We get a lot of revenue from that standpoint. So it's great news. On the flip side of that is the Nigerian people, 250 million people who have to go to the pump today and buy a PMS, greater than 100 and 1,200 or 1,100 naira per liter. So it's a tale of two sides of it. And from a Nigerian standpoint, it's a bit of a mixed bag. I think the fundamental thing for Nigeria to think about here is very much like many other countries who have a strategic petroleum reserve. Nigeria needs to start to look at that. Yes, we are petroleum producers, but the whole concept of having a strategic petroleum reserve, like we've seen in the US, like we've seen in China, like we've seen in the UK, Germany, and many countries, we have to have a strategic petroleum reserve that allows us to cushion some of that effect. I mean, NNPC right now is having to go onto international markets to try to get WTI. If we had a lot of that in our reserve right now, you pass that onto the refinery, and that would be incredible. So it's something I think that's missing from our arsenal that we have to start to think about. The President Bola Ahmed Tinubu's administration needs to wear a thinking hat because this disruption, unfortunately, are here to stay. This will be the new normal going forward. In fact, just this conflict we're talking about, in the best case scenario, if this conflict ends today, before we can come out of the mess that we're in right now, it would take at a minimum 4 weeks to come out of the mess that we are. If it goes longer, a tiny bit longer, I can tell you this, expect crude oil at at least $150 per barrel. And if we have a full war scenario, beyond $200 per barrel, all of these scenarios could play out. And countries need to start to think about how it is that they can cushion the effect on their general population.
All right, this is almost looking like this might be the Black Swan event. But, we're hearing from South Korea, they're set to impose a price cap on fuel products. And this is for the first time, in 30 years. Definitely, I feel there's a cost for this.
Yeah. So, Ladi, exactly to your point, there are, different countries are dealing with the price shock in different ways. You just mentioned it. South Korea, the president, just FYI, they just went through elections at the tail end of last year. They have a new president, and he has come out to say, you know what, at oil at $120 per barrel, I'm going to insulate my population from that. So basically, it's some form of a subsidy. So they're going to cap. They'll cap the cost of PMS at the pump, okay, a bit like a subsidy, some sort of government subsidy, and they've made allowance for that. They have a fund that would, sort of alleviate that, if you like. So that's one way to deal with it. And bear in mind, South Korea is an energy importer. It's a petrol importer or crude oil importer. So, okay. Now, other countries are dealing with it slightly differently. Just this morning, if you flip it over, the G7 countries, so we're talking the US, we're talking UK, Germany, Japan, Italy, and France, G7, all of them met together and they are looking at jointly releasing their strategic petroleum reserves via the IEA, the International Energy Agency that coordinates this. So they're looking to deploy their strategic petroleum reserve. And that is why, Laddie, so you mentioned $120, $119 per barrel. That was the peak of it. At the announcement of that news, the price of Brent crashed from 119 all the way, I think, right now to about $103 per barrel, because it's very clear that the G7 are going to put a lot more barrels onto the market and, sort of increase production, increase supply, as it were, so it can crash the price. So that's what we're seeing. There are several strategies that different countries are using. South Korea is putting a price cap. G7 countries are opening their strategic petroleum reserves. And then guess what? Vietnam on the other side is thinking about removing the petrol levy on imports. So if you're importing petrol into the country, the taxes and levies and all of that are being removed to give a very favorable, atmosphere and circumstance for people coming in. So different countries are trialing different strategies here and there. And of course, we have Nigeria. You and I just spoke about Nigeria. NNPC is going to the markets to procure WTI to make sure it's available to the refinery, to our domestic refinery. So yes, there are different strategies that we're seeing at the moment. I'm not sure which one's the best one for now, but we just hope that this conflict can be resolved in a short space of time, because if this goes further, the global economy could come into recession. You know the clear link between energy prices and food prices, energy prices and the price of services. All of those are linked together. If this lingers on for a long time, then we could see the global economy going into recession.
Yeah, and we see President Donald Trump calling it a small price to pay, which could be a huge price, for other countries. And I'm sure the central bankers now, they'll be getting quite nervous at this time. But thank you so much, Chinan, for helping us unpack what's playing out right there in the oil market. Thank you.
Pleasure. Thank you.
And talking about volatility, I was also seeing that with the safe haven trade. Gold prices, they retreated today, but traded above their session lows as, escalation in the U.S.-Israel war with Iran, that spurred flows into the dollar and oil. So there you have it. That's the color right there for the metals market. Just like we started last week, Monday, with most of the safe haven trades there falling. Copper is also down. Platinum, the biggest mover down there for $2,109 per ounce. And we see spot gold, but still holding on to $5,000 level, but down by 1.6% so far this morning. All right, let's get a check now on what's playing out with other countries at this point. We see Kenya, they're set to channel 15 to 20 billion shillings, about 116 to $155 million from the planned Kenya Pipeline Company IPO to expand the country's main aviation gateway, Jomo Kenyatta International Airport in Nairobi. President William Ruto says the project will be the first major investment under the National Infrastructure Fund aimed at easing congestion at the busy airport and supporting Kenya's broader infrastructure development plans. Moving on now, we see South Africa's currency is under pressure. At the start of the week, the South African rand weakened sharply to around 16.85 against the US dollar, its lowest level in nearly 3 months, as investors pulled back from riskier assets. The sell-off follows a surge in global oil prices, raising concerns about inflation and economic growth. While South Africa's benchmark 2035 government bond, that's the yield there, also edged higher in early trading. We see Tunisia, they're planning a major upgrade to their aviation infrastructure. The government says it will spend about $1 billion to expand the Tunis-Carthage International Airport, boosting the airport's annual passenger capacity to 18.5 million travelers. According to Reuters, the project is part of a broader effort by Tunisia's Ministry of Transportation to modernize the country's aviation sector and prepare for rising passenger traffic in the years ahead. And looking at startup funding now, we see some recovery on the continent. In February 2026, 40 startups had raised more than $272 million in deals worth at least $100,000, marking a sharp rebound from January's $174 million and slightly above the past year's monthly average. Most of the capital came through equity financing, with debt also playing a significant role, suggesting investor confidence in Africa's innovation ecosystem may be strengthening again. And we see 4 Nigerian business heavyweights have once again secured their place among the continent's richest individuals. According to the latest Forbes Africa Billionaires ranking, Aliko Dangote, Abdulsamad Rabiu, and Mike Adenuga and Mr. Femi Otedola have all made the 2026 list of Africa's billionaires. The ranking highlights Nigeria's continued presence among the continent's wealthiest business leaders, with fortunes spanning industries from cement and manufacturing to telecommunications, energy, and finance. Analysts say the appearance of the 4 entrepreneurs underscores the influence of Nigerian capital in shaping Africa's private sector and investment landscape. Their inclusion also comes at a time when the continent's billionaire class is seeing significant shift in wealth, reflecting changing market conditions and new industrial investments across Africa. And the government of Ghana, they've marked their 69th independence anniversary with a renewed call for stronger economic ties with Nigeria. Speaking at the reception hosted at the Ghana Consulate General, the Minister Councillor and Head of Chancery, Barbara Enti, emphasized the importance of deepening trade and investment links between the 2 West African nations. Take a listen.
Say that Ghana and Nigeria have enjoyed a very cordial relation since our Independence Day struggles. Both our forefathers have teamed up in the struggle for independence. And since then, Ghana and Nigeria have been like brothers and sisters. We intermarry when it comes to economics. We have Nigerians investing in Ghana. We have Ghanaians who are also doing well in Nigeria. So both in terms of government, we've been cordial. In terms of people to people, there are things that we do in common. You know, like I said, investment in Ghana, and also Ghanaians also investing in Nigeria. We've intermarried. We enjoy soccer together. We do a lot of bantering on social media when it comes to who is cooking the best jollof and the rest of it. But on the whole, we see Nigeria as our brother. We have a brotherly, sisterly.
Denmark has an Africa-century strategy, where Nigeria is 1 out of 4 regional hubs on the continent. So Nigeria is a super important market for Denmark. Also commercially, we have a number of companies here. We've been here for many years. We are the only Nordic country with a consulate general in Lagos, actually. And we are simply scaling up and stepping up. So that is why we are here. We are not holding back, and Nigeria really offers not only about, Lagos is not only about Lagos. Lagos is not only about Nigeria. For us, it's a regional hub. And that means a lot of opportunities, but also we can learn a lot from Nigeria.
All right, let's turn straight to the markets now. Let's see how most of major markets are doing. Looking at Africa, for the African continent, last week, we see major bosses on the African continent last week Some of them managed to close in the green, like Nigeria. If we look at the performance for last week, Nigeria did eke out a gain of about 2%, but we see the South Africa index dropped a lot, about 9% down. That's for the whole of last week. Namibia dropped about 9% last week. Then we did see pockets of green. Then EGX 30 dropped big again also last week. If you can put that up for me, last week performance. But for today, EGX 30, 0.96% down. Nairobi Stock Exchange for Friday, 0.74%. That was the last close, but for the week, okay, there you have it. Thank you. Nairobi Stock Exchange, 3.55% down. That's for the whole trading week. EGX 30, 3.45% down. Then we see the NGX there, keeping up 2.15%. That's for the whole trading week last week, and already giving us direction of what to expect for the NGX this week. So that's the picture right there. Let's move on to the Gulf regions now. And as expected, then red, 2.77% for the UAE. That's the Dubai index. Abu Dhabi index, 0.41% down. Move over to Saudi Arabia and the Qatari index there. We're still seeing pressure right there, 1.29, 2.60%. Big drops, just like last week. That's what we're seeing play out with these markets. If we look at the stock futures in the U.S., we're also seeing pressure there. Dow Jones Industrial Average, 1.28% down. The tech-heavy NASDAQ, 1.20% for the futures. Let's look at what to expect this week. For Tuesday, we're expecting data in the U.S. Also, most of this week there, we see Governor Bailey is going to be speaking on Thursday. That's for the BOE. U.S. CPI data, we'll get that on Wednesday. Core CPI for the U.S., that's on Friday. Then for Tuesday, ADP weekly employment change, that's also in the U.S. So with all the volatility we're seeing, geopolitics, there's data that will also drive sentiment this week. Let's take a turn now to Europe. We have Chiponda Chibelu right there. Hello, Chip. Happy New Week. We're still seeing escalation right there. How are the markets looking in Europe?
Hi, Ladi. Well, it's not such a happy week, at least at the beginning of the week for the markets for sure. But European markets are recovering a bit after slumping in the early session, and the pan-European stock 600 is actually now down around 1.3%, and so is the DAX, and they were both down more than 2% in early trading. Now, the stock 600 has actually erased the gains it has made so far this year, and that is because investors don't see a swift end to the Iran war. Oil-producing Middle Eastern countries are already cutting output as storage capacities run out, and that means a return to normal oil production will take longer, even if the Strait of Hormuz is unblocked, and that is because it takes some time to normalize production after output cuts. Now, all of this, Ladi, is bad news for Europe, which is, of course, for the most part, a net energy importer, and that will hurt Germany, which is the continent's biggest economy and industrial powerhouse, because it is more exposed to energy shocks, more than its European peers.
Yeah, and just how vulnerable is the German economy to the energy shock?
Well, Ladi, leading economists here are already warning of rising inflation and investment uncertainty. Now, oil prices have already, of course, spiked above $100 a barrel. And last week, the average price of diesel was hovering at just over €2 a liter, which is 30 cents higher than it was before the beginning of the war. And natural gas prices also spiked at even quicker paces than oil. Now, these jumps are not only being felt, of course, by German households, but also by the country's energy-intensive industry, so chemicals, mechanical engineering, and the auto sector, which are, of course, the backbone of the economy. So the effect will ripple also in the country's politics too, because of course German voters are still waiting for the economic revival that was promised by German Chancellor Friedrich Merz in the run-up to the election at the beginning of last year, the federal election at the beginning of last year.
So what do we expect right there in Europe this week?
Well, what should we expect? The first regional elections here of 5 here in Germany show that Germans are unhappy with the federal government. And yesterday on Sunday, voters surveyed during the polls in the third most popular state, Baden-Württemberg, say that they are unhappy with the conservatives and social democrats in the federal government. And they believe that German Chancellor Friedrich Merz has failed to deliver on the economic promises that he made in the lead up to the federal elections last year. And that, of course, is a sign that the economy is a huge deal. And from the first regional elections in Baden-Württemberg, we have seen that the far-right AfD party came in third, and it also had the biggest improvement. So there is a lot riding on Germany's economic performance this year. And of course, now a lot of that will also depend on how long this war in Iran, the war that is being waged by the US and Israel against Iran, how long it lasts and how much of an energy shock there is. Now, last week, of course, the more pessimistic analysts were predicting that European gas prices could surge as much as 130%, Ladi, given that disruption in the Strait of Hormuz. Now, the fact is that, of course, Germany is more vulnerable. And so that will, of course, have consequences, not just for its economy, but also for its political landscape, potentially.
Right. Major countries counting the costs right now. Thank you so much, Chip, for the updates. I'll see you tomorrow. All right, let's get a quick check on what's playing on the crypto market. And definitely, it's not red, even though it's a major risk asset. We're seeing Bitcoin in the green. It's been a range trade so far, touching 70, coming right back down from that. Ethereum still holding on, $2,000. Not much to see here. BNB, $630 and pockets of red there. Major news there, cryptocurrency exchange Coinbase, they've launched a new futures offerings in Europe, expanding their push, to give investors and users on their platform, other types of investments. Then we see crypto ATMs are increasingly being exploited. That's according to recent data by scammers and illicit actors, according to a new report from the U.S. Department of Treasury. Then according to some market data, we see trading volumes in Tokyo-based exchange have jumped more than 200% within 24 hours, all in the back of what's playing out right there in the Middle East. So that's Business Incorporated today. The markets are buzzing heavily. We'll give you more updates and track it so you know what to do in these markets. Thanks for watching. I'm Ladi Williams. Bye for now.